Hey guys, welcome back to the channel. My name is Sam, and today we're going to be talking about the S&P 500 and its annual returns. Quickly, let's gonna look up what it is exactly. So just go look up on Google what the definition is, and you can see the S&P 500 index, or the Standard & Poor's 500 index, is a market capitalization weighted index of 500 of the largest publicly traded companies in the US. So it's not exactly the top 500 companies, but there's other criteria to be included in the index, and the index is widely regarded the best gauge of the large cap US equities in the US. So pretty much it just takes 500 companies that are large cap and that best represent the US economy. So let's have a look at the stock performance of the last couple of years. We're just gonna go on Yahoo Finance, take a quick look here. So we're just gonna type in S&P 500 in here. And this is pretty much the S&P 500 from the early 1900s. You can see this is 1929. There's a big dip back in the early 1930s, and it just keeps going a little bit hilly. And again, this is history. I'm not too familiar with what happened in the economy back then, but in a more recent past, I'm more familiar with the 2000s, so the last about 21 years. So we're gonna go have a look at that. So here we are in the 2000s. This is the peak of the dot-com bubble. There's a big crash in 2002. Moving up, the economy did really well, and then there was the 08-09 crisis. Again, it dropped all the way to the bottom, almost where the dot-com crisis was. And then for the last 10 years, it's been a bull market. It's been booming ever since. A little bit of a slowdown in 2016, and here you can see in 2020 there's the global pandemic, and there's a little bit of a dip there, and ever since that until today it's been at its all-time high. So I want to show you what would happen if you actually invested at the peak of the 2000s and where your money would be at today. So let's go through that together. So the best way to do this is look at the S&P 500 annual returns. So we're going to type this into Google, and on the first one, macrotrends.net, it shows you every year the return on an annual basis. So we're going to click on the last 20 years, but we want the last 30 years just because we want to include the dip from the 2000s. You can see the 2000s, that gave a -10, -13, -23%. Then it went up 26 and so forth, went green for a little bit. There's a big dip in 2008, -38%, and then it rallied back for the next almost 10 years. Again, there's a little bit of a slowdown in 2015, and also a little bit in 2018 as well. And even in the year 2020, it went up around 16%. So that was really encouraging there. Next, if you scroll down, you can be able to see the list of all the year and their annual returns. So I'm going to take that and paste it into Excel. So we have our data here. I'm just going to put in that we have $100 in the beginning of year 2000, and let's see what happens every year if we put this $100 in the S&P 500. So in the very first year, if you were to put in $100, you would get back $98. So after 1 year in 2000, we lost $10. In 2001, we lost 13%, so now we're at $78. In 2002, we lost 23%, and let's see how much we're going to lose. I believe it's going to be about 60 bucks. We're all the way down to $60 here. In 2003, we gained 26%, so we're going to get some money back at $75. 2004, 9%, so $82. 2005, we're at 85, then 86, then 99. So at this point, this is 7 years. Think about this. It took us 7 years just to break even. So we started with 100 and now we're at 99.93. So it lost 7 cents, but took us 7 years. And if you think about it, this is where we are on the chart. So again, it took us 7 years just to go through that hill, just to break even. So 2008, you know it's not going to be pretty. We're -38%, and it's going to bring us to $61. Now 2009, and moving forward for the next almost 10 years, it's been a really good market. It's almost all green, and if anything, there's only a couple negatives. Okay, so 2011 was 0%, 2015 was negative a little bit, 2018 was only -7%, but for the most part, it's been really good. So in 2019, we finally have $219. We finally doubled our money. If you count all these years, this is 20 years. It took us 20 years just to double our money. So not great, but also not bad as well. And at the end of year 2020, we have $255.61 with just putting in $100 in the S&P 500 for the last 21 years since 2000. So again, let's have a look at what this yield us. So just putting a formula together, this yield us a total of 156%. So 156% in 21 years. So that's actually not too bad. So let's have a look if we actually started investing at the start of 2003. So after all the negative, all the dot-com bubble recovery. So let's have a quick look at that. So let's have a quick look. You can see that we're going to get a lot more money than before because we avoided all those losses. And by the year of end of 2020, we're going to have $426. So we would have doubled our money a couple times now. And let's have a quick look at the percentage. So you can see that the first 11 years, that's where we first doubled our money. So it's not bad. So we get to $210 in 2013. And then in the next 5 years, from 2013 to 2017, we get another $100 at $303. And then from 303 to where it is right now, $426, that's just another 4 years. So again, not bad. And if you have a look at the total percentage, we're going to be making 326% from our initial investment. This was about 17 years ago. So I'm going to run one more example, assuming that we started our investment in 2008. So we bought at the peak of 2008, right before the crash, right, and then we're going to lose all 38%. Let's have a look. So you can see we put in $100 right now, and then in year 2020, we're going to have $255. That's 155% gain. So think about that for a second. That's a lot, right? And that's only in about 12 years, 12, 13 years time. So not too bad at all. So yeah, just going back to the chart, just look at the trajectory. You're looking at 155% gain in the last 12 years. So the moral of the story is that long-term investing works if you just put it in a broad index fund. Sure, it might take you, 5, 10, 15 years for you to double your money. But at the same time, where else are you going to be able to make that kind of money? With investing, there's only really 3 ways for your money to make you more money. Number 1 is probably the stock market. Number 2 is real estate. And number 3 is buying businesses. And those are the only 3 ways for you to make your money make money for you. So thank you for watching. I appreciate you watching it until the very end. Like this video if this was helpful for you, and subscribe if you want to see more videos like this. Thank you very much. I'll see you guys in the next one. Bye.